Learn the fastest way to make millions with strategies that took me from $0 to $1 million. I'm Noah Gold, and welcome to my channel, your guide to wealth. Subscribe and let's get rich together.
Welcome to Wealth Journey, everyone. I'm Alex, and today we're tackling an exciting challenge: how to turn $5,000 into $500,000, a 100x return. Joining me is Emma Carter, a seasoned investor from New York. Emma, it's 2024 and the U.S. markets are a roller coaster with inflation and tech stocks making headlines. How should someone with $5,000 kick off this journey?
Thanks, Alex. Turning $5,000 into $500,000 is a bold goal, but it's doable with the right mindset and strategy. First, let's establish the basics. You need a stable job, spend less than you earn, and save consistently. That's the bedrock of wealth building. For the $5,000, I'd go with Plan B, a low-risk, long-term approach. In 2024, the S&P 500 feels overvalued, so I'd recommend investing in Vanguard's Total Stock Market ETF, VTI. At an 8% annual return, the Rule of 72 tells us your money doubles roughly every 9 years.
9 years to double sounds steady, but how does that get us to $500,000?
Great question, Alex. If you're 25 in 2024, you've got about 40 years until you hit 65. With an 8% return, that's roughly 4 doubles. $5,000 grows to $80,000. Now, if you add $3,000 in annual savings from your job and invest it consistently, you're well on track to reach $500,000 by retirement. No need for flashy moves, just discipline. My take: too many Americans get sidetracked by chasing quick wins. Think crypto fads or meme stocks like in 2021. The real magic is in boring, consistent compounding. It's not glamorous, but it's how wealth is built.
That's a solid foundation, Emma, but 40 years is a long wait for some of our listeners. What's Plan A for those who want to hit that $500,000 goal faster? That's a solid foundation, Emma, but 40 years is a long wait for some of our listeners. What's Plan A for those who want to hit that $500,000 goal faster?
Great point, Alex. Plan A is about hunting for rare, high-return opportunities, what I call 2x4 moments, because they hit you like a plank of wood with obvious value. These are investments where the numbers scream undervaluation, often because the market misprices uncertainty. For example, back in 2020, during the pandemic, I found a U.S. logistics company, Transfreight, whose stock plummeted 85% due to collapsed shipping demand. But their assets, trucks and warehouses, were worth 3 times the stock price. I put 10% of my portfolio in, and within 18 months, it tripled as demand roared back. My take: most investors miss these gems because they fear uncertainty. But when you combine low risk with high uncertainty, you get massive rewards.
That's incredible, Emma. But how do you distinguish between a low-risk opportunity and something that's just plain risky?
It's all about second-order thinking, asking, and then what? With Transfreight, I saw that even if shipping demand stayed low, they could sell assets to stay afloat, limiting downside. When demand returned, supply constraints drove shipping rates sky-high, boosting the stock. You don't need complex models for this. If you can't explain the investment to a 10-year-old in 5 sentences, it's too complicated, pass on it. My advice: in 2024, look for sectors hit hard by temporary fears, like retail or energy, where solid companies are unfairly punished. Dig into their balance sheets to find hidden value.
So, finding these 2x4 moments sounds like a treasure hunt. Where do you even start looking, and what kind of mindset do you need to spot them?
It's exactly like a treasure hunt, Alex, and it starts with temperament. You need patience and a laser focus, like a detective combing through clues. Back in the 1950s, a famous investor would read entire financial manuals page by page to find mispriced stocks. That's extreme, but the principle holds. Dive deep into a few areas you understand. For example, in 2023, I focused on small-cap retail stocks battered by e-commerce fears. One chain, Shop Local, was trading at $5 a share, but its real estate was worth $15 a share. I studied their leases, foot traffic data, and local market trends, things I could grasp. That's my circle of competence. My take: in 2024, most Americans are distracted by headlines, AI, inflation, elections. Stay narrow. Pick one industry, learn everything about it, and ignore the noise. Platforms like Seeking Alpha or Motley Fool's free reports can help you screen for ideas, but always do your own homework.
That focus sounds intense. Can you give us a real-world example of someone who mastered this narrow approach?
Absolutely. Think of Sarah Walton, the founder of a major U.S. retail chain. She was obsessed with retail details, down to measuring aisle widths in competitors' stores to optimize her own. She'd visit failing stores not to gloat but to learn, like spotting a clever display that boosted sales. Her mantra was, learn from everyone, even the losers. That's the mindset. Know one thing deeply. My advice, in 2024, you don't need to read 1,000-page manuals. Start with something familiar, maybe real estate or consumer goods, and study 10 companies inside out. If you can't explain why a stock is a steal in simple terms, move on.
Welcome back to Wealth Journey. I'm Alex, and we're continuing our conversation with Emma Carter, a seasoned New York investor, on how to turn $5,000 into $500,000 in 2024's wild U.S. markets. In Part 1, Emma shared Plan B, a steady compounding strategy with Vanguard's total stock market ETF, doubling every 9 years. In Part 2, she revealed Plan A, hunting for 2x4 moments like Transfreight, where undervaluation led to a 3x return. Emma, you just mentioned the importance of temperament and focusing on your circle of competence, like Sarah Walton's retail obsession. But what pitfalls should investors avoid to stay on track for that $500,000 goal?
Great question, Alex. One of the biggest traps is over-leverage and complexity. Let's start with leverage, borrowing money to amplify returns. It's tempting, especially in 2024 with low interest rates creeping back. But leverage is a double-edged sword. Take the story of Tom Reynolds, a talented investor in the 1970s. He used heavy margin loans to buy undervalued stocks, including a stake in a conglomerate similar to Berkshire Hathaway. When the market crashed, he was forced to sell at a loss, missing out on shares that later soared to 100x their value. My take, leverage can wipe you out faster than it builds wealth. For a $5,000 portfolio, stick to your own cash. If you can't afford to lose it, don't borrow to bet it.
Ouch, that sounds like a painful lesson. So how do you keep things simple and avoid that kind of disaster?
Simplicity is the key to staying sane and successful. Great investments don't require PhD-level math. If your idea needs a spreadsheet with 50 tabs, it's probably too complex. For example, in 2022, I looked at a tech startup with a convoluted revenue model, subscriptions, ads, and crypto tokens. I couldn't explain it clearly, so I passed. Instead, I invested in a boring Midwest grocery chain trading below its inventory value. It doubled in a year because the math was clear. They had more assets than debt. My advice, in 2024, avoid overhyped sectors like AI startups with murky business models. Stick to what you can understand, like real estate or consumer staples, and always ask, what's the worst that could happen? If the downside's too steep, it's not worth it.
Emma, your advice on avoiding leverage and keeping things simple like passing on complex tech startups is a great reminder to stay grounded. But sometimes the market throws up opportunities that seem scary but might be gold mines. How do you navigate situations with high uncertainty but low risk to get closer to that $500,000 goal?
That's where the magic happens, Alex. High uncertainty, low risk is the market's blind spot where fear creates bargains. Wall Street dumps stocks when the future's unclear, but if the fundamentals are solid, you can strike gold. For instance, in 2021, a U.S. renewable energy company, GreenWave, tanked 70% because of rumors about slashed clean energy subsidies. But their 10-year contracts were ironclad, and their solar farms were worth double the stock's market cap. I put a small portion of my portfolio in, and it quadrupled in 2 years once the panic subsided. My take, in 2024, sectors like green tech or small regional banks are getting hammered by short-term fears, think rate hikes or policy shifts. If their assets and cash flows hold up, those are your low-risk bets.
That's a powerful way to flip fear into opportunity. How do you separate these hidden gems from the real duds?
Discipline and a too-hard pile. If you can't clearly assess the risks, walk away. With GreenWave, I saw no major debt due soon and guaranteed revenue, low risk, despite the noise. If there were red flags, like shaky loans or regulatory dependence, I'd toss it in the too-hard pile. Most ideas, probably 95%, belong there. My advice, For a $5,000 portfolio in 2024, don't swing at every pitch. 1 or 2 well-researched bets a year can move the needle. Be humble, know your limits, and stick to what you can analyze.
Emma, your approach to high uncertainty, low risk, like Greenwave's 4x return is eye-opening. It's clear that discipline is key, especially with that too hard pile. Let's talk about timing and consistency. How important is it to start early, and what does staying disciplined look like for someone aiming for $500,000 with just $5,000?
Starting early is everything, Alex. Time is your biggest asset. If you're 25 in 2024, that $5,000 invested at 8% annually can grow to $80,000 by 65 with just 4 doubles, as we discussed in Plan B. But the real power comes when you add consistent savings, say, $3,000 a year from a job. That pushes you toward $500,000 by retirement. Start at 35, and you're playing catch-up, the math gets brutal. My take: in 2024, young Americans are bombarded with distractions, TikTok stock tips, crypto hype. Discipline means ignoring that noise and sticking to a plan, whether it's monthly ETF contributions or researching one great stock a year.
Starting early makes so much sense, but staying disciplined sounds tough in today's world. Any practical tips for keeping focus?
Absolutely. Treat investing like a marathon, not a sprint. Set up automatic investments to your ETF or brokerage account. $250 a month adds up. And limit your decisions. You don't need 50 stocks. 1 or 2 high-conviction bets alongside your Plan B portfolio is plenty. I learned this from a mentor who only made 3 big investments a decade but crushed the market. My advice: in 2024, avoid checking your portfolio daily. It's a recipe for panic. Review quarterly, stick to your circle of competence, and spend less than you earn. That's how you stay on track for $500,000.
Emma, your approach to high uncertainty, low risk, like Greenwave's 4x return is eye-opening. It's clear that discipline is key, especially with that too hard pile. Let's talk about timing and consistency. How important is it to start early, and what does staying disciplined look like for someone aiming for $500,000 with just $5,000 in 2024?
Starting early is the ultimate game changer, Alex. Time is your greatest ally in investing. If you're 25 in 2024 and invest $5,000 at an 8% annual return, the rule of 72 says it doubles every 9 years. By age 65, that's 4 doubles. $5,000 becomes $80,000 without lifting a finger. But the real power kicks in when you add consistent savings, like $3,000 a year from a job. That can push you toward $500,000 by retirement. Start at 35, and the math gets much tougher. You're fighting a shorter runway. My take: in 2024, young Americans are drowning in distractions, crypto pumps on X, TikTok stock gurus. Discipline means tuning out that noise and committing to a boring, repeatable plan.
That long runway really puts things in perspective. But staying disciplined with all that noise sounds like a challenge. Any practical tips for keeping on track?
Absolutely, Alex. Think of investing as a marathon, not a sprint. First, automate your investments. Set up $200 to $300 a month to flow into your Vanguard ETF or brokerage account. That removes emotion from the equation. Second, limit your decisions. You don't need a portfolio of 50 stocks. 1 or 2 high-conviction bets a year, alongside your Plan B, is enough. I had a mentor who made just 3 big moves a decade and still beat the market. My advice: in 2024, don't check your portfolio every day. It fuels panic and bad choices. Review it quarterly, stick to your circle of competence, and always spend less than you earn. That's the discipline that turns $5,000 into $500,000 over time.